Right now, as of March 2026, three defense ETFs, ITA, XAR, and SHLD, are up between 52 and 78% year-to-date. Gold is near record highs. Energy stocks are surging on Middle East conflict premium. War stocks are having their moment. But here is the question almost nobody is asking. What happens to your portfolio the day a ceasefire is announced? Because it will come. It always does. And when it does, the money that flooded into defense, energy, and gold will rotate, fast, into 5 sectors that have been sitting out the rally. This is the playbook. The Swiss Finance Institute found that markets tend to fear uncertainty before a war more than the war itself, and that once peace becomes visible, capital rotates decisively away from defense and commodities. After the Gulf War ended in February 1991, the S&P 500 returned over 20% in the following year. After the Iraq War low in March 2003, consumer discretionary and technology led the market recovery. The Motley Fool reviewed 6 major conflicts and found that defense stocks rise sharply at onset, then often give back gains within months of resolution. Edward Jones noted in March 2026 that on days peace talks emerge, even preliminary ones, consumer discretionary and materials are consistently among the top performers, while energy and real estate lag. The pattern is clear. The playbook is 5 sectors. The 5 post-war rotation plays. Number 1. Consumer discretionary ETF. When geopolitical fear fades, consumer confidence returns. People book holidays. They buy cars. They go to restaurants. Consumer discretionary is the single most consistent post-conflict outperformer in the historical record. In March 2026, Edward Jones flagged consumer discretionary as a top performer on ceasefire headlines. The SPDR Consumer Discretionary ETF, XLY, gives you Amazon, Tesla, McDonald's, and Home Depot in one position. Vanguard's VCR is the lower-cost alternative at a 0.09% expense ratio. Canada. Both XLY and VCR trade on U.S. exchanges and are TFSA/RRSP eligible for Canadian investors. The risk? Consumer confidence is fragile. A recession following the conflict erases this thesis entirely. Number 2. Industrials and infrastructure. Post-war reconstruction drives industrial demand. When Russia invaded Ukraine in 2022, Goldman Sachs immediately ran scenario analyses, elevating industrials as a key beneficiary of any peace outcome. Infrastructure ETFs like PKB, the Invesco Dynamic Building and Construction ETF, and broad industrials exposure through XLY capture this. U.S. Concrete, Caterpillar, Deere, and Vulcan Materials benefit directly from rebuilding. Individual name, United Rentals, URI, the largest equipment rental company in the world, has historically re-rated sharply when construction activity accelerates post-conflict. Canada. These trade on U.S. exchanges and are RRSP/TFSA eligible. The risk? Reconstruction timelines are long and politically uncertain. The actual revenue often takes years to materialize. Number 3. Real estate. Wars push capital out of real estate as uncertainty rises and interest rates climb on inflation. When the conflict ends, that process reverses. Falling geopolitical risk premium means central banks have more room to pause or cut rates, and lower rates are the single biggest driver of REIT re-ratings. Vanguard Real Estate ETF, VNQ, and iShares US Real Estate, IYR, are the 2 primary vehicles. Charles Schwab's sector analysis for 2026 notes that REITs tend to outperform during economic recovery phases as rent collections and property values normalize. Canada. XRE, iShares S and P/TSX, capped REITETF, is the direct Canadian equivalent. The risk? If post-war inflation remains sticky and rates stay elevated, the thesis does not work. Number 4. Financials and banks. Banks make money on certainty. War drives uncertainty, credit stress, and volatile rates, all of which compress bank earnings and multiples. Peace deals remove that premium, and bank stocks re-rate quickly when the geopolitical risk premium falls. The 2026 rate environment adds another layer. If ceasefire reduces inflationary pressure and central banks gain room to normalize policy, the yield curve steepens, which is structurally bullish for bank net interest margins. SPDR, Financial Select Sector, ETF, XLF, gives broad U.S. financial exposure. SPDR S&P Bank ETF targets pure-play banks more directly. Canada ZEB BMO Equal Weight Banks ETF covers the big six Canadian banks, which have been suppressed by both the conflict environment and rate uncertainty. The risk: if peace triggers a growth scare rather than a relief rally, financials underperform. Number 5. Long-duration bonds. This is the pure macro play. Wars drive inflation, and inflation drives up bond yields, which means bond prices fall. The iShares 20-plus year Treasury bond ETF, TLT, has historically been one of the weakest performing assets during active conflict. When a ceasefire is announced and geopolitical risk premium begins unwinding, inflation expectations drop, yields fall, and TLT re-rates sharply upward. MSCI's cross-asset analysis of 5 geopolitical shocks found that once oil prices normalize post-conflict, government bonds benefit directly from the inflation unwind. Vanguard Total Bond Market, ETF, BND, is a more conservative, diversified entry. Canada, VAB, Vanguard Canadian Aggregate Bond, ETF, captures the same dynamic domestically. The critical caveat: this only works if post-war inflation actually retreats. T. Rowe Price noted in March 2026 that if conflict-driven supply shocks persist even after fighting stops, bonds do not benefit in the near term. You do not wait for the ceasefire to be announced. By the time it is official, these positions will already have moved. You watch for the signals: a 5th round of peace talks, a UN resolution passed, a ceasefire framework published. That is your window. Not the announcement itself, but the 48 hours before it becomes certain. History also tells you what not to do. Do not panic sell your defense positions on the first ceasefire rumor. The Swiss Finance Institute found that markets fear uncertainty more than war itself, which means false starts and broken ceasefires will punish anyone who positioned too early and too aggressively. Scale in gradually. Never abandon your core long-term strategy for a macro theme. And remember, the same war stocks that are up 52 to 78% this year have reversed hard after every previous ceasefire in history. The question is not whether they will pull back. The question is whether you are positioned for what comes next.